You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, last week we took some time to get together and answer some of your listener questions, so please make sure that you keep those coming. They're always some of my favorite episodes when we get a chance to actually talk, answer all your questions that you have from all the previous shows. But this week, we're going to get right back into the swing of things in that we are getting into the Nifty 50. A boatload of companies will be announcing earnings this week, and a lot of them are the FANG stocks. So I'm going to start off by doing Apple. We are taping Options Playbook Radio. Today it is April 21st. It's Wednesday. The market is open, and Apple will be announcing earnings on Wednesday of next week. So we're going to put this trade together. The estimated earnings date is on April 28th, and it will be after the close. That's what it is. That's when it is anticipated. So we will be putting this trade together a little bit ahead of time. We're going to do a trade that's looking for more volatility as opposed to less volatility. Right now, we're seeing, if we look at the Apple chain and we look at the May 7th expiration, which is the expiration date that we're going to be looking to use here, we see that the implied volatility on the option contract is about 36%. That's not bad overall. We anticipate it could go up a little bit going into the earnings, but in general, it's been fairly low relative to what Apple has done during the pandemic over the last couple of earnings sessions. So we're going to make a guess that we will see more of a move as opposed to less of a move. Now, there's two ways that we can approach it. We could go in and we could buy a long straddle. And using that same expiration, if we bought the long straddle, we bought the most at the money call and bought the most at the money put. We currently have Apple trading at 132.33, so we'd be looking at the 132 strike. We have the midpoint right around $8.20. So that would be about the type of money that we're going to put up on our trade. But overall, we're going to make it a trade that does not mind a little bit of time decay if you're right on your forecast, as opposed to doing the long straddle, which does not like time decay in general. So how can we do that? The trade is actually going to be called a volatility spread, or otherwise known as a backspread. Now, As always on Options Playbook Radio, it's not meant to be a recommendation whenever we talk about any of these trades. But with this one, you could actually decide which direction you'd like to go. You're going to use at the money option contract. That's going to be our main focal point of our trade today. And because of that, you could just flop it one way and do it and be bullish to the upside, or you could do it the other way and be bearish. It's basically your choice. So here's the trade that we're going to look at. We're going to use that May 7th expiration, which time is your friend in this trade. That's 16 days away. The more time you have for this one to play out, the better you're going to be. But that would be pretty much the same thing as a long at the money straddle. You would like more time as opposed to less time overall. But you also expect implied volatilities to come in too if you are looking at doing that trade. Now, we're going to do it to the call side. We're going to be looking at selling an in the money call option. We're going to sell the May 125 strike call, and then we will be buying 2 of the May 133 strike calls. Now, that's an 8-point move, which the marketplace is saying that that's approximately what Apple could do around earnings. And that's the type of move that we're looking for. If we don't think that it can move more than 8 points after earnings in either direction, well, then we don't want to do this trade overall. All right, so if I'm doing this entire trade, I'm selling that in-the-money option contract to pay for 2 of the at-the-money option contracts. And right now, with the markets rocking and rolling, we can see the midpoint of this trade is $1.20 or $120. Now, our total risk is the width of the spread. Now, you also have to remember that it's the width of the spread minus the net credit received to the account. So the width of the spread is $8 minus the $1.20. Our total risk is $6.80. And that does affect the move. Ideally, we're thinking that this can move at least that $6.80. But if it doesn't quite get there and only moves around $7, we should be okay on the trade. We're just going to want to react after earnings. This is totally an earnings trade. The only way that I may stay in it all the way to expiration is that if the market was quite a bit down in that scenario, and down meaning that it would be below our strike that we sold, the 125 strike, because in that scenario, we want all of our option contracts to expire worthless. And the only way that we could receive that entire net credit is that at expiration, Apple finishes below that 125 strike. There is no time premium left. All the options expire worthless, and we end up with that $120 net credit to our accounts. So this is an interesting alternative to doing a long straddle in that it doesn't benefit you as much to the downside as it could to the upside. It does not mind time decay as much as a long straddle does, but it's still a concern in that if you put this trade on and the market does not move at all, they announce earnings and stock stays right around 133, that's where your most risk is at. So if I'm doing this trade and the market just doesn't move much after earnings, that's your biggest concern here. And if that happens, you just want to close it as fast as possible. And having a few extra days, and by that I mean the May 7th expiration, as opposed to looking at that April 30th expiration, which is right after earnings, which would be the Friday after earnings. We actually give ourselves a little bit of protection because time is our friend. If we are wrong on our forecast and that underlying stays basically where it's at or makes a small move in either direction, and small I would say would be about half of the expected move or about 4 points in either direction. All right. So If to the upside, we do get more than the expected move, we get more than 8-point moves to the upside, we'd be looking at unlimited upside potential because we are long one more call option than we are short. So that is by far our best case scenario. And that's why I mentioned it to be at the top of the show that if you wanted to, you could take this same formula, be about 8 points wide, and sell the in the money put and buy 2 of the at the money calls. And basically that just means you're going to be bearish on Apple going into earnings, and you would have almost the same type of risk reward profile as you do on the call side. So pick a direction. Where do you think it would go? Decide if you want to use calls and be bullish or if you want to use puts and be bearish. And that's how you would approach the trade. So let me summarize exactly what we're looking at today. All right. We are taping Options Playbook Radio. It is Wednesday, 4/21. The markets are open. They are rocking and rolling. We have Apple last trade at 132.16 right now, down 95 cents on the day. We are going to do a call backspread that will expire after the earnings date on the 28th. And that backspread is we're going to be selling 125 strike call and using the proceeds to buy 2 133 strike calls. We're going to do this for a net credit of $1.20 to the account, or $120 less commissions. Our maximum risk on this trade would be the width of the spread, $8 minus that net credit of $120, or $6.80, or $680. We're going to have that as a margin requirement in the account once we put that trade on. Our risk is if that underlying stock does not move at all. It stays right around the 132 or 133 level after earnings, and we don't get that big of a move to the upside or the downside. Our best bet is that we move at least 8 points in either direction. That's really what we're hoping for. And if you don't think that that can happen, then you don't put this trade on. So that's going to be it for this episode of Options Playbook Radio. Now, I will mention this, that we might do this a little closer to the actual earnings event, but we tape Options Playbook Radio on a specific day at a specific time, so we always use those prices. So you might want to think about doing this the day before or the day of. But as we look at the trade, no matter when you set it up, these would be the general rules that you'd be using. You're going to be looking for more than the expected move. You're going to pick your strikes based off of that, and you're going to hope to receive a net credit to the account when you put on the initial trade. If you have any other questions that you'd like me to answer on the show, please email them to me at theoptionsguy@invest.li.com. You can also follow me on Twitter. My handle is @BrianOverby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.